Listen up. If you're watching silver right now and you think the move from $30 to $85 was the story, you haven't seen anything yet. Because 2 weeks ago, President Trump announced a sweeping tariff framework that's about to do something to the silver market that most people aren't even considering. Not just a price shock, not just a supply disruption, but a complete repricing of the physical supply chain that could push silver past $150 per ounce before the end of 2026. And here's the part that should terrify institutional shorts and get physical buyers very, very excited. This isn't speculation. This is math. See, most analysts are looking at Trump's tariffs through the lens of trade wars, negotiations, and political theater. They're asking, will China retaliate? Will Mexico cave? Will Canada buckle? But they're missing the mechanical part. They're missing the input cost cascade that happens when you slap a 25% import tax on refined silver, copper cathodes, zinc concentrates, and rare earth elements, all of which flow into the same processing facilities, the same logistics chains, and the same commodity exchanges that price silver. So today, I'm going to walk you through the supply chain math that the mainstream isn't covering. I'm going to show you how tariffs don't just raise prices, they fracture delivery networks, force rationing, and trigger procurement panic that can send spot prices vertical in a matter of weeks, not years. And I'm going to give you the three-phase timeline for how this plays out, the warning signals to watch, and the exact levels where silver either consolidates or goes parabolic. Because here's the reality. If you're waiting for $150 silver to confirm before you act, you'll be buying at $120 and wondering why you didn't pay attention when the countdown started. So stick around, grab a notebook, and let's do the math that Wall Street doesn't want retail investors to understand. All right, let's start with what actually happened, because the headlines don't capture the full scope. On January 20th, 2026, President Trump signed an executive order reinstating and expanding Section 232 tariffs on critical mineral imports. The language was broad, but the targets were specific. 25% tariff on refined silver imports from non-allied nations, specifically Mexico, China, Peru, Chile, the 4 largest sources of U.S. silver supply. 25% tariff on copper cathodes and concentrates from the same list, additional 10% to 15% levies on zinc, lead, and certain rare earth processing intermediates. Now, the official justification was national security, the same legal framework Trump used for steel and aluminum tariffs back in his first term. The argument is that the U.S. depends too heavily on foreign processed metals, which creates vulnerabilities in defense manufacturing, grid infrastructure, and critical supply chains. Fair argument? Maybe. But here's what matters for silver investors. The tariff isn't hypothetical. It's active. And it takes effect in 60 days, March 31st, 2026. That means any refined silver entering the U.S. after March 31st from Mexico, China, Peru, or Chile will be subject to a 25% import tax at the border. Now, let's talk about what that actually means in practice. Here's the part most people don't understand. The United States does not produce enough silver domestically to meet its own demand. Let me give you the numbers. According to the USGS, U.S. Geological Survey, and the Silver Institute, U.S. domestic mine production of silver in 2025 was approximately 31 million ounces. That's it. Total U.S. silver consumption, industrial, investment, jewelry, medical, was roughly 190 million ounces in 2025. So we produce 31 million and consume 190 million. That's a 159 million ounce deficit that has to be filled by imports. Now, where do those imports come from? Top sources of U.S. silver imports, 2025 data. 1. Mexico, 85 million ounces, 45% of imports. 2. Canada, 38 million ounces, 20% of imports. 3. Peru, 28 million ounces, 15% of imports. 4. Chile, 18 million ounces, 9% of imports. 5. China, refined products, 12 million ounces, 6% of imports. 6. Other, Poland, Australia, Bolivia, etc., 10 million ounces, 5% of imports. Now look at that list. Canada is on the Allied exemption list, Trump specifically carved them out in the executive order. So Canada's 38 million ounces still flows freely. But Mexico, Peru, Chile, and China, which together account for roughly 143 million ounces of U.S. imports, are now subject to the 25% tariff. That means 75% of U.S. silver imports just got hit with a 25% price increase at the border. Alright, let's do the first order math, the simple direct cost pass-through. Let's say you're a U.S. manufacturer. You make solar panels and you need 1,000 ounces of refined silver per month. Before the tariff, you were buying that silver at $85 per ounce from a Mexican refinery. Your monthly silver cost was $85,000. Now the tariff kicks in. Your supplier still charges $85 per ounce. But when that silver crosses the border, U.S. Customs hits it with a 25% import duty. That's an additional $21.25 per ounce. So your new effective cost is $106.25 per ounce. Your monthly silver bill just jumped from $85,000 to $106,250. That's a $21,250 per month increase, a 25% cost increase, and you haven't changed a single thing about your operations. Now, what do? Option 1, eat the cost. You absorb the $21,250 and take the margin hit. But if you're operating on a 10% margin, that $21,000 just wiped out more than half your profit. Not sustainable. Option 2, pass the cost to customers. You raise the price of your solar panels by 5% to 8% to cover the silver cost increase. But now you're less competitive against Chinese panels, European panels, or domestic competitors who locked in cheaper supply before the tariff hit. Option 3, switch suppliers. You try to source silver from Canada, Poland, or another exempted country. But here's the problem. Those refineries don't have spare capacity. They were already selling everything they produce. There's no massive pool of unused Canadian silver sitting around waiting for U.S. buyers to show up. So you end up competing with other manufacturers for a limited supply of tariff-free silver, which drives up the price of that Canadian silver anyway. Not through tariffs, through scarcity bidding. Option 4, reduce usage. You redesign your product to use less silver, or you cut production entirely. This is demand destruction and it's real, but it doesn't happen overnight. Retooling a manufacturing line takes months. So in the short term, you still need the silver and you have no choice but to pay the higher price. Do you see how this works? The tariff doesn't just raise prices through a direct tax. It forces procurement decisions that create scarcity, bidding wars, and delivery delays, all of which put upward pressure on spot prices. Now let's talk about the second-order effects, because this is where things get dangerous for industrial users and explosive for silver investors. See, refined silver doesn't just magically appear at a factory door. It moves through a complex logistics network. 1. Mining in Peru, Mexico, Chile, etc. 2. Concentration and smelting, often in the same country or nearby. 3. Refining to 0.999 or 0.9999 fineness in specialized facilities. 4. Transport to port, via truck, rail, or barge. 5. Ocean freight to U.S. ports like Los Angeles, Houston, New York. 6. Customs clearance, where the tariff is assessed. 7. Domestic transport to bullion dealers, industrial buyers, COMEX warehouses, mints. Now, what happens when you add a 25% cost shock at step 6? First, shipping and logistics companies start rerouting. They look for ways to minimize the tariff impact. Maybe they route through Canada for partial processing, even if it's inefficient. Maybe they hold silver offshore in bonded warehouses and delay imports, hoping the tariff gets repealed or renegotiated. Second, refineries in Mexico and Peru start diverting supply to other buyers, Europe, Asia, domestic Mexican industry, where they don't face the 25% haircut. Why sell to a U.S. buyer at $85 when a German buyer will pay $88 with no tariff friction? Third, U.S. industrial buyers start pre-buying and hoarding. If you're a solar manufacturer or a tech company that uses silver in semiconductors, and you know a 25% cost increase is coming in 60 days, what do? You buy 6 months' worth of inventory right now before the tariff kicks in. You front-run the deadline. And when dozens or hundreds of companies all do that at the same time, you get a demand surge in February and March 2026 that sucks up available supply, drains COMEX inventories, and spikes prices before the tariff even takes effect. This is procurement panic, and it's already starting. I've seen reports from bullion dealers saying commercial orders for 1,000-ounce bars have doubled in the last 2 weeks. Industrial buyers are locking in supply. They're not waiting for April. Now let's talk about the COMEX warehouse system, because this is where the tariff could trigger a full-blown supply crisis. As of January 27, 2026, COMEX registered silver inventory, meaning silver available for delivery against futures contracts, sits at roughly 42 million ounces. That's the lowest level since 2016. Total COMEX inventory, registered plus eligible, is around 310 million ounces. But remember, eligible silver is not deliverable unless the owner decides to re-register it. It's essentially private storage using COMEX vaults. It's not available for the market unless someone chooses to sell. So the real deliverable supply is that 42 million ounces in registered. Now here's the math. If U.S. monthly silver demand is roughly 16 million ounces, 190 million annual divided by 12, and 75% of imports, 143 million ounces annually, or 12 million per month, are now tariffed, you've created a monthly supply stress of 9 million to 12 million ounces that's now more expensive or harder to access. Where does that stress show up? COMEX registered inventory. Buyers who don't want to pay the tariff or can't get physical delivery from Mexico or Peru because of delays will turn to COMEX futures and demand delivery. They'll stand for delivery, drain registered inventory, and force the exchange to either find more metal or trigger a short squeeze. And here's the kicker, refineries know this. So they have an incentive to hold metal offshore and wait for U.S. spot prices to spike before they import and pay the tariff. Why import at $85 and pay a $21 tariff when you can wait 2 months, import at $110, pay a $27 tariff, and still sell into the U.S. at $130 because domestic supply is tight? This is the supply chain arbitrage that happens in a tariff regime. It doesn't smooth prices, it amplifies volatility and creates delivery bottlenecks. Now, let's talk about the geopolitical wildcard, because tariffs never happen in a vacuum. China is the world's largest silver consumer, industrial usage, and also a significant exporter of refined silver products. When the U.S. slaps a 25% tariff on Chinese silver, what does China do? Historically, China's playbook is asymmetric retaliation. They don't match tariffs dollar for dollar. They target strategic bottlenecks. Possible Chinese responses: 1. Export restrictions on rare earth elements, which the U.S. needs for EV batteries, wind turbines, defense systems. China controls 70% of global rare earth refining capacity. They can choke that supply overnight. 2. Quotas on refined copper and aluminum exports to the U.S., which would cascade into broader industrial cost increases. 3. Incentives for domestic Chinese industries to consume more silver internally, reducing the amount available for export. This tightens global supply even further. 4. Strategic yuan devaluation to offset the tariffs' impact on Chinese exporters, which would make U.S. imports cheaper in yuan terms but wouldn't reduce the dollar-denominated tariff burden on American buyers. And here's the critical point. If China retaliates by restricting rare earth exports, U.S. manufacturers face a double squeeze: higher silver costs and higher rare earth costs, both of which hit EV, solar, and defense supply chains at the same time. That's not a trade skirmish. That's a supply chain crisis. And when supply chains fracture, commodity prices don't drift higher, they gap higher in a matter of days. All right, let's build the math for the $150 price target, because I don't throw numbers out for clicks. I throw them out because the structure supports them. Here's the cascade. Phase 1, February-March 2026 pre-tariff front-running. Industrial buyers pre-purchase 3 to 6 months of inventory before March 31st deadline. COMEX registered inventory drops from 42 million ounces to sub 30 million as delivery demand spikes. Spot silver rises from current $85 to $95 to $100 on anticipation alone. Phase 2, April-June 2026 tariff activation and supply disruption. Tariff takes effect March 31st. Mexican and Peruvian silver imports slow as exporters reroute or hold offshore. Domestic spot prices decouple from global spot. London fixes at $100. New York trades at $115 due to supply tightness. First reports of delayed shipments and force majeure declarations from refineries hit the news. Industrial buyers panic bid for available metal. Silver spikes to $120 to $130. Phase 3, July-October 2026 short squeeze and speculative momentum. COMEX registered inventory falls below 20 million ounces, a critical threshold that triggers margin hikes and delivery fears. Hedge funds and algorithmic traders cover short positions, creating a technical squeeze. Retail investors pile in on momentum. Silver ETFs see record inflows. Media coverage amplifies silver shortage, tariff crisis, etc., creating FOMO buying. Silver tags $150 in a parabolic spike, possibly touching $160 to $175 in an intraday blow-off. Total timeline, 8 to 9 months from now, October 2026. Now, does silver stay at $150? Probably not. Blow-off tops usually retrace 30% to 50% within weeks. But the new floor after that shakeout would likely be in the $100 to $120 range, which is double where we started. And if geopolitical risks escalate, if China retaliates, if Iran tensions spike oil, if the Fed cuts rates again, that floor could be even higher. All right, let's talk about the real-time signals you need to monitor to confirm this thesis or adjust if it breaks down. Signal 1. COMEX registered inventory levels. Track this weekly. The data is public, published every Monday on the CME website. If registered inventory drops below 35 million ounces, that's yellow alert. Below 25 million ounces, that's red alert. Below 15 million ounces, you're in squeeze territory. Signal 2. Silver futures backwardation. Backwardation is when near-term futures contracts trade higher than longer-dated contracts. It's a sign of immediate physical demand outstripping supply. If March or April 2026 silver futures are trading above December 2026 futures, that's a scarcity signal. Signal 3. U.S. spot premium over London. Track the spread between COMEX spot and London Bullion Market Association, LBMA spot. If New York silver is trading $5, $10, or $15 above London silver, that means U.S. supply is tight and buyers are paying up for domestic delivery. Signal 4. Refinery and dealer allocation notices. If you start seeing bullion dealers announce allocation limits, maximum 500 ounces per customer, delivery delays of 6 to 8 weeks, that means wholesale supply is constrained. That's a leading indicator that spot prices are about to catch up. Signal 5. Mining company guidance. Watch for earnings calls or press releases from major silver producers, First Majestic, Pan American Silver, Hecla, Kerr Mining. If they start talking about elevated demand, supply tightness, or export restrictions, that's confirmation the stress is real. Signal 6. Presidential or trade negotiation headlines. If Trump announces a tariff exemption or delay, silver could pull back 10% to 15% in days as the panic bid unwinds. Conversely, if China announces rare earth export restrictions, silver could gap up 20% overnight. Trade policy is the swing variable. Watch it closely. All right, let's be honest. This isn't a guaranteed trade. Let's talk about what could break this thesis. Risk 1. Tariff gets repealed or delayed. If Trump faces political pressure, Congress, corporate lobbying, supply chain chaos, and he delays or softens the tariff, the front-running bid disappears. Silver could retrace from $95 back to $80 or even $75. Risk 2. Massive eligible to registered conversions. If COMEX warehouses see a wave of eligible silver, currently 268 million ounces, suddenly re-register as deliverable, that floods the registered category and eases the squeeze. This is unlikely but possible if prices spike enough to incentivize holders. Risk 3. Demand destruction. If silver hits $120 to $130, some industrial users will cut consumption, delay projects, or switch to alternatives, like copper in certain electrical applications. That reduces physical offtake and caps the upside. Risk 4. Global recession. If the U.S. or global economy tips into recession in mid-2026, industrial demand for silver, solar, autos, electronics could collapse, overwhelming the supply-side tariff impact. In that scenario, silver might rally to $110, then roll over. Risk 5. Fed pivots hawkish. If inflation reaccelerates and the Fed hikes rates instead of cutting, the dollar could surge and commodities could sell off. Silver is particularly sensitive to real yields. If 10-year TIPS yields spike, silver could struggle. These risks are real. They need to be monitored. But as of January 29, 2026, none of them are active. The tariff is signed. Inventory is falling. Demand is strong. And the Fed is still in easing mode. So the base case is bullish. The risk case is less bullish or sideways. The bearish case requires a major policy reversal or economic shock. Alright, here's how to position for the tariff-driven silver spike. Strategy 1. Physical accumulation, but front-load it. If you're a physical silver buyer, by now, in February and early March, before the tariff kicks in and before the pre-buying rush peaks. Don't wait for confirmation at $110. By then, premiums will be 15% over spot and delivery delays will be 8 weeks. Buy generic rounds or bars, not numismatic coins. You want the cheapest way to get silver exposure. American Silver Eagles, Canadian Maple Leafs, or 100-ounce bars from recognized refiners, Sunshine, Asahi, Metaller. Strategy 2. Silver ETFs for liquidity. If you want price exposure without storage risk, buy SLV, iShares Silver Trust, or PSLV, Sprott Physical Silver Trust. PSLV is preferable because it's backed by allocated, audited silver and trades closer to net asset value. ETFs let you sell quickly if the move goes parabolic. Physical silver is harder to liquidate at retail without eating 5% to 10% in spreads. Strategy 3. Silver miners for leverage. If you want outsized gains, buy silver mining equities. When silver rises 50%, miners can rise 100% to 200% due to operating leverage. Top picks, not financial advice. Do your own research. First, Majestic Silver, AG. Pure Silver Play, Mexico Exposure Pan American Silver, PAAS. Diversified, Strong Balance Sheet Hecla Mining, HL. US-based, Low Geopolitical Risk Wheaton Precious Metals, WPM. Streaming/royalty model, less operational risk. Strategy 4. Call options on SLV for high risk, high reward. If you're comfortable with options, buy out-of-the-money call options on SLV with expirations in September or December 2026. Target strikes at $120, $130, $140, based on SLV's silver price tracking. This is speculative, but if silver goes parabolic, those calls could return 500% to 1,000%. Risk is limited to the premium you pay. Strategy 5. Scale out on the way up. Don't hold everything to $150. If silver hits $110, trim 20%. If it hits $130, trim another 25%. If it tags $150, trim another 30%. Keep a core stack, 20% to 30%, for just-in-case scenarios, currency crisis, war, financial system stress, but take profits on the majority. Remember, $150 silver is a spike, not a plateau. You want to sell into euphoria, not chase it. Alright, let's bring this home. Trump's 25% tariff on silver imports isn't a headline. It's a structural repricing event that will cascade through the entire supply chain, from Mexican refineries to COMEX warehouses to industrial buyers to retail stackers. The math is simple. The U.S. imports 143 million ounces per year from tariff countries. That's 12 million ounces per month that just got 25% more expensive. COMEX registered inventory is 42 million ounces, enough to cover maybe 3.5 months of tariffed import shortfall, and only if nobody else demands delivery. Industrial buyers cannot wait. They will front run. They will panic bid. They will drain inventory. When that happens, silver doesn't drift to $150. It gaps to $150 in a matter of weeks, then consolidates or retraces. And the people who win are the ones who positioned before the move, not after. So here's your homework. This week, 1. Check your current silver position. Do you have exposure? If not, why not? 2. Set price alerts at $95, $105, $115, and $130. Know when the move is accelerating. 3. Bookmark the COMEX inventory page. Check it every Monday this month. 4. Decide your entry strategy. Physical, ETF, miners, options, or a blend. 5. Execute at least one position before March 15th, 2 weeks before the tariff activates. This quarter. 6. Monitor the 6 signals I gave you. Adjust your position size and exit strategy as new data comes in. And if you found this breakdown valuable, do me a favor. Comment tariff math below so I know you're paying attention. I read every comment, and it helps me understand what kind of deep dives you want more of. If you want faster updates, daily voice notes, chart breakdowns, and real-time alerts when COMEX inventory drops or tariff news breaks, join my premium WhatsApp channel. Link is in the description. That's where I share the insights that don't make it into full YouTube videos. And subscribe to this channel and hit the bell if you haven't already. Because the next 8 months are going to be wild for silver, and I'll be covering every twist, every spike, and every opportunity as it unfolds. Trump's tariff shock is real. The supply chain math checks out. The countdown has started. The question isn't if silver rallies, it's whether you'll be positioned when it does. Plan now, execute smart, and I'll see you at $150.